You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everyone, and welcome to this week's podcast. Thank you for being here. Today, I wanted to talk about what interest rate should I charge myself on my loans against my life insurance contract for the infinite banking concept. I got asked this question a few times, actually, in the last few weeks, so I thought I would just do a podcast on it. Most people, when they take out a loan from their insurance policy or against their insurance policy, they think, well, I'll just pay whatever the company is charging. Whatever their rate is, that's what I have to pay back. They don't really necessarily think about, oh, well, the company's charging me 4%. Maybe I'll pay myself 8% or 10% or 12%. They don't really think about paying themselves back more interest than what the insurance company requires. That's definitely something that Nelson Nash taught, to pay yourself back at a higher interest rate than what the insurance company will charge you. And insurance companies, they all charge something different. The older contracts I was working with were charging about 5% to borrow the money. Some older contracts, from different companies, maybe at 8%. Nowadays, the newer contracts I'm working with are at 4%. So you can access funds for your lifetime guaranteed at 4%. That's pretty terrific, I think. A lot of companies have only a variable rate option or only a fixed rate option. The variable rates are climbing up just like every other variable rate right now. It is nice to have the fixed rate option because it's guaranteed never to go up. And one of the contracts I'm working with is pretty awesome. You can go back and forth between fixed and variable, depending on what kind of loan you would like at that time. And there's some more detail around that. It's not that simple, but you can go back and forth, which is cool. So back to Nelson Nash and him talking about charging yourself more interest than the company is charging you. He has a little story in his book, Becoming Your Own Banker, where he talks about a grocery store and just the whole process of how you charge your customers. And if you have a captive group of people buying from you, such as your family, that maybe you should even charge them a couple more cents for their groceries, because at the end of the day, it's going to make your business more money. And if it's like your family, they would want you to be doing better anyway. It's going to all come back to them. And so he's just saying, for sure, what you don't want to do, you don't want to steal the peas. That is a very popular statement he would say all the time, don't steal the peas. And when he's saying that, he really just means don't steal from yourself. Don't borrow money against your policy and then not pay it back at all. He wants us to treat ourselves like an honest banker, treat our policies like we are an honest banker. And when we borrow that money, pay the policy back just like you would to any bank loan, which most oftentimes are more interest. Those loans have a higher interest rate than if you're borrowing against your policy. So charge a comparable amount of interest or higher for a loan that you would get for, say, a car. Maybe you're borrowing against your policy to buy a car. What interest rate would they charge you there? Charge yourself at least that much, maybe some more than that. Or for any other kind of loan you're looking for, pay yourself what you would have paid that bank, because you would have paid them with no problem when you're looking for that money. But when it comes to your own money, for some reason, we feel like we shouldn't have to pay ourselves back or shouldn't have to pay any interest on it. But it actually is going to help you come out ahead. It's going to help you to come out with more money. So it is a good idea to pay yourself back with higher interest and get used to it. You're going to be the one who ends up with the excess. So it's going to be a win. So another question I get all the time when someone says, okay, maybe I will charge myself 10 or 12% interest. How do I get that interest back into my policy? Do I just pay it back to the loan and it all works out? Or how do I get that extra interest into my policy? How does it fit in? So if you're charging yourself something like 10 or 12% for your loan that you just took against your policy, you are not going to be able to fit that back into the policy. You can only fund the premium payment that you're making, and you can only pay back a loan and replenish it plus the interest that the insurance company is charging. They're not going to allow you to fit a whole 12% back into the contract if they're only charging 4%. So how do we do it? How do we get it in there? Well, most often what we would do or advise you to do is to open a segregated account, a separate bank account to keep track of the accounting for your insurance and your banking needs, the way that you're going to be banking. So you open a separate bank account, call it a family fund account with your last name or whatever you want to call it to keep it separate. And then we'd get together, we'd figure out what your payment's going to be at the interest rate you want to charge yourself and the amount of years, how long do you want to pay yourself, the rate. We figure out 2 out of these 3 variables and figure out your payment. And then once you have your payment figured out, you can send that payment to your segregated account instead of to your life insurance policy directly. Now, you certainly absolutely can send it directly to the life insurance company from your regular bank account and keep paying it back that way. But this is just one way to keep the accounting more clean and to be able to see what's happening and to be able to see those extra funds when you're paying yourself back at a higher rate. I just wanted to clear it up for those people who really want to be technical about it. And so you can open the segregated account, send your loan repayments to this separate account, and then from there, have the life insurance company draft the amount to pay back the loan with the company, and they'll draft it from this new account, and then you'll be paying back the loan to the insurance company, but you'll be sending your payments to your own bank account rather than directly to the insurance company, so that once the loan is paid back with the insurance company, your payments that you're still going to have to make will be going to your segregated account. Because if you have a loan and we draft at 12% interest, you're going to end up paying on it for a longer time frame, let's just say, than you would if the loan was only at 4%. So you're going to end up with excess funds that can't go back into the life insurance policy. But to be an honest banker, you still want to be able to pay yourself back at that interest rate that you want to charge yourself. So you put it into the segregated account, a separate account. And then those funds can accumulate there. And then at the same time, you can have funds draft from this account and go right to the insurance company to pay back your loan. So as an example, let's say you take out a loan and the company's charging you 4%, and you would have paid that loan off at your chosen monthly payment, whatever that is. It would be paid off in 4 years, let's just say. You chose the monthly payment, you're going to pay it off in 4 years at 4%. But if you're charging yourself at 12%, and if you're having that amount of money go right to the insurance company at 12%, your loan is simply going to end up getting paid off faster than 4 years because your payment is higher, because you're going to be paying in more funds and the loan's going to get replenished before 4 years. So it's not going to be possible to pay for a full 4 years at 12% into your directly from your bank account to your life insurance policy because you can't fit all that cash into it. Because there's restrictions with your life insurance policy. You can only pay the premium, the amount that you borrowed, and the interest that the company is charging you. So with that segregated account, you would be able to fund for the full 4 years at 12%. And then from there, you can have the company, again, draft out that amount each month or whenever to pay back your loan. So you can set up an automatic payment to pay back your loans with the company, or you can let that money accumulate there. You can let it accumulate there. And then you can pay back the loans whenever you want. You can call the company, you can send in funds, or we have a document that you can use to send funds in whenever you want to replenish your loan. You also, so you could pay that back whenever you want, quarterly, semi-annually, randomly, whenever you want. So if you have a loan that you're planning to pay back based on your own amortization schedule, because you want it to be an honest banker over a 4-year time period at 12%, and for example, I did not figure this out perfectly, the life insurance company gets paid off or paid back in 3.5 years, then you're going to have another 6 months roughly of payments that are going to build up inside of your segregated account. Now, what to do with those extra payments? You can direct them to paid up additions in another life insurance account, maybe on a spouse or a child. You could send them to fund a loan repayment on another account as well. So it could go to another paid up additions account or another loan repayment account on another account. Or you could use it to start up a new policy. You could use it to help fund paid up additions on a new policy. Or you could have it be the whole premium for a new policy, depending on the amount that's in the account. Maybe it is the premium to start a second policy. So as those funds accumulate in your segregated account, you can choose to use them however you wish. And I mean, you can choose to do this the whole time. You don't have to have the company drafting every single month from that account. You can let them accumulate and then use those funds to pay back the loan at your time whenever you want to do it. Or you could have it go to paid up additions. So if you have your loan repayment building up inside of your segregated account and you haven't made a payment back to the company yet, and it's just building up in that account, and then the year's going on and you think, I might need help this year funding my paid up additions, maybe because you pay an annual premium or something like that, then you could direct those funds to help you pay the full paid up additions premium and then continue making your loan repayment. Maybe you extend your loan repayment an extra year so that you can do that to yourself, so that you can move some of that money to a different location to paid up additions rather than loan repayment. Then you just extend your loan out a little bit longer so that you're still being an honest banker and that you still get those funds repaid. I think the thing to keep top of mind is that the more premium you pay into the policy, that's how you grow your system. You're going to grow your banking system, your pool of cash with premium dollars. Because when you're borrowing against your policy and paying it back, that's a way to recycle your own money and use it again and again and have it replenished again for when you get to retirement. Now you have a full pool of cash from which to use in your retirement years and access it income tax free. But until then, while you're in your building years, while you're growing your system, the way that you're going to grow your banking system is through premium dollars. I'm going to give you an example, and this is totally not exact, but just to kind of help you think it through. If you owned shares of stock for a company that were dividend paying shares of stock, so you were earning dividends on this. So the more stock you own, the more shares of that stock that you own, the more of the dividends that you'll receive because the more of an owner that you are. And that's how it works. It works sort of like that with the insurance company, because when you have a life insurance contract with a mutual life insurance company, you are a co-owner on that policy. You are an owner with the company on that policy. Therefore, as an owner, you will receive dividends on that contract. So the more premium you're putting in, like the more of an owner you are with the insurance company. And then also you're creating a larger and larger pool of cash that's going to be guaranteed to grow with guaranteed crediting rates. And every time you earn a dividend that's going into that pool, now that dividend is making your pool bigger and now it's going to be earning guaranteed rates, just creating a large snowball that gets bigger and bigger each year. So the premiums are helping you to become more of an owner, helping you lock in more growth on a larger pool of cash, and helping you to earn more of the dividends. So keeping in mind that the best way to grow your system is through adding more premium, another thing to think about when you're paying your loans to yourself is that after you've paid the loan off completely, it's paid off to the company, maybe you have accumulated some extra funds, or maybe you haven't. Maybe you've just had a draft straight from your bank account and now your loan's paid off. But you're used to making this loan to yourself, this loan repayment to yourself every month to the insurance company. So now you've just freed up, let's say $500 a month because you were used to paying that to yourself on the loan that you just paid off with the insurance company. Another thing you can do is begin using that $500 or maybe a different amount, maybe $300, maybe $700 to begin a new policy premium payment on a new contract. It could be another contract on your own life, could be a contract on a family member, a spouse, your children. But then if you're doing that, you're adding more premium dollars, you're putting in more premium, you're locking in more growth, more dividends, and you're going to have a larger pool of cash at the end of the day. So I'll just say this again, or kind of put it another way. The larger the pool of cash that you build inside of your banking system in your life insurance policies, the larger the amount that you're going to be earning a guaranteed crediting rate on. And also the larger the pool of cash you have, the more you're able to use that money for purchases that you need or to take over debt, or if paying off your mortgage happens to be your primary goal. You need a large pool of cash to be able to do more things with it. Growing that pool of cash as large as possible is also going to help you in your retirement years because you're going to want to have as much as possible in those years to access income tax free. So that's all I have for you today. I hope that you enjoyed it. I hope that it was helpful. I hope that it helped cleared up some questions for you or for some of you. If you would like to connect and ask for my help, if you'd like to work together, you can reach me at Valerie at alphaomegawealth.com. I would love to hear from you. I would love to help you figure out how you could put a system together and start making this work for your family. So please reach out if you'd like. I hope that you have a great week, and we'll talk to you next time. Take care.
This is the podcastfactory.com.